Now, when we use the favorable and unfavorable variance concept, the variance means the deviation, the distance, so no negative value. Only we measure as the favorable or unfavorable, the difference between the actual and expected. So when we recognize this, the profits and revenue and cost, and compare this actual with the expected, we use just the logical way rather than the memorizing some formula. For example, in the profits, if actual is greater than the expected, now we make a better performance, revenue as well. But the actual cost is greater than expected, that is unfavorable. And then actual is lower than the expected, now is totally opposite. So please think in a logic rather than the memorizing some formula. Okay, so let's practice once again. Here, when the actual is greater than expected, again the favorable. When cost of the actual is greater than expected, now this is unfavorable. What about profit? That's correct. That is favorable. Then if actual is lower than expected, it's now the totally opposite. Totally opposite. So based on this understanding concept of this, the favorable, unfavorable in sales cost and profits, now we want to create the variance analysis comparing actual and static budget. The static budget is the budget when we expected at one single level of activity, the 9,000, the units sold level, but actual was 7,000. So we do not change this static budget along with the actual budget 7,000, the sales unit. We just compare the static budget and actual. So on the variance, we use just simply ABC function. ABS function, sorry. ABS function means absolute value difference. Absolute value difference between two. Any number you can put first. Then it shows automatically, right, the positive number, because again the variance is deviation, the distance. And then let's drag it down. Okay, so you can see that we can make the variance. Then I want to fix some unnecessary part. Then we found the variances here on the sales unit and the total the variable cost in variance, and then the fixed cost. So let's identify if it is the favorable or unfavorable. So for the sales unit, the actual sales was lower than the static budget. So this is unfavorable. And then sales amount is also definitely unfavorable. What about the variable manufacturing cost? The actual cost now was lower than the static budget, the budget. So we saved the money. So that is the favorable. Also, the selling cost actual was lower than this is static budget, favorable. And administrative cost. Okay, in actual we spent $200 more than the budget, so unfavorable. Then total variable cost, we saved 37,930, mostly because of the variable manufacturing cost savings. So the favorable, and contribution margin also. Now contribution margin we saved, so contribution margin is the favorable. Oh, sorry, it's my mistake. This contribution margin is now has been reduced, so it should be unfavorable. And the fixed manufacturing cost. Fixed manufacturing cost, we spent more the fixed manufacturing cost, so unfavorable. And then we just match it, the static budget as actual, so favorable. And then total fixed cost is automatically unfavorable. So total, the operating income, the difference between these two actual and the static budget. So the static budget, we expected positive operating income, but we turned to the 11,570, the operating loss. So this is unfavorable. Okay, so we're done, and see you in the next video clip. Bye bye.